Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. November saw a record number of new ETF product launches and a near-record month for inflows. 2023 was the year for actively managed ETFs and for short-term bond ETFs. Billions flowed into money market-like ETFs to capture those 5% yields. Will that continue into 2024? Should investors start moving that money back into equities? Let's talk with Ben Slavin. He's the global head of ETFs at BNY Mellon. Andrew McGorman is the managing director at Wallach Beth Capital. Ben, BNY Mellon, you're the largest asset service provider in the ETF industry. You see all the flows, $1 trillion into money market funds in 2023. I think we're at $6 trillion right now. This end of the year rally back into stocks, are we seeing flows back into equity ETFs? Are people putting their money where the market is going?
Well, look, that's exactly what we saw here in November. You saw that enormous cash pile up go into money markets, and ETF flows were muted. Then November comes and we started to see that money really come back off the sidelines. You saw almost $100 billion in flow into ETFs. And again, unlike the beginning of the year where we saw that flow going into fixed income, especially at the short end of the curve, you saw some selling in fixed income and a large piece of that money going into equities for sure.
Andrew, some of the big trades this year do seem to be reversing. $94 billion in inflows in November. But I noticed something very interesting here. We had $94 billion in inflows. Year to date, $460 billion. Here's the new numbers here. That's just shy of $500 billion, where we would consider it significant. But look at this, outflows from ultra short government bonds. $7.1 billion. There's been inflows all year into that. Yeah. This month, this is for the month of November, outflows of $7.1 billion. I wonder if that is start of a trend here.
I think it shows you some confidence in the market. Just look at the general economy. The spending is starting to ease up, like on the restaurant and retail level, and then that should be the top. The market lags the economy. We know. The economy lags the market. We know that. So I think that's a sign that more money is going to come in. And you talked about the money market funds. How about all the money that's in like the Goldman Sachs Marcus accounts and that aren't even in ETFs? All that is probably money that people took out of equities, even if they're just single stockholders, because of a lack of confidence in the market besides the big seven. And now they're going to start to see, okay, it's safe to get back in the market. They never get in at the bottom, right? We've seen a little bit of a rally. I think that's going to be a big sign for 2024.
The knock on this whole story about all this money on the sidelines and money market funds is a lot of it is like, my mother's savings account. They weren't in stocks to begin with. She just moved it out. Actually, this is a true story. My mother moved money out of her savings account in March. Right. Into
for 5%,
into one-year CDs, and she's not necessarily going to go back into the stock market. So, but there is a point here about this that people seem very comfortable with that 5% yield. But as yields start going down, those money market yields are going to start coming down. Those are short-term instruments by definition. It seems logical that the stock market, if this continues, has got to recapture some of that money. It seems logical.
Absolutely logical. Look, that 5% yield is giving equities certainly some competition. Again, you've started to see that switch. But, really, if you step back and you look at what's going on in flows, and again, it's just indicative of maybe where investor sentiment is going to be going forward. But in November, over 1,800 different ETFs were positive, and over 200 took in, a significant amount of money, more than $100 million each. So it is broad-based. And again, as those money market yields come down, things will change. And certainly there are some investors that are looking to lock in those rates at the longer end of the curve.
That's what I think. I think they're going to get used to 5%. Like you said in the example of your mother, she's used to 1%, now gets 5%. So even some of the younger investors are going to say, okay, I was really comfortable with 5%. You're not going to get it in a money market, but you're going to get it in a dividend-producing ETF, in one of the option derivative ETFs. You can still get that yield. And I think that's where the money will flow, or even high-yield ETFs, the traditional.
And we talk all the time about flows, and I just want to point out something. Most of the time, flows are noise. I don't pay a lot of attention to them, but $94 billion last month, that was a fairly large number. That was statistically significant. Would you say so?
Yeah, it certainly was. I think it was the 5th highest on record, so that's got to get your attention. Although seasonally, ETFs have done well in Q4. I think, again, here part of it was the markets. The other part, certainly, I think tax loss harvesting is another big catalyst for ETF flows. So certainly there's noise in the number, but it was definitely
tax loss harvesting with ETFs.
Well, look, I think in certain, certainly in the mutual fund structure, you saw many funds, certainly on a relative to ETFs, pay capital gains. And these are situations where it provides investors an opportunity to harvest losses, rotate back into another product, and often ETFs have been the beneficiary to be able to, quote unquote, harvest those gains, and then again, maintain their market exposure. And again, a lot of this seems to happen in the fourth quarter, which makes sense, obviously, given tax planning, but also when these funds make their capital gain distribution announcements, so investors can calculate what their tax liability might be.
How about the bigger index names, SPY, Qs?
Yeah, using that for tax loss harvesting. Okay, are investors still piling into big cap tech stocks, or are they positioning themselves for a broader recovery in 2024? I've been noting the RSP, the equal weight S&P 500, has been outperforming the S&P, the market cap weighted S&P, for over a month, and there's been inflows into the RSP. That signals some kind of confidence.
Look at the whole market rallies. I don't think tech can keep the same lead they had before. Like you have a product like the Pacer Cows, COWZ, right, which is a value play, which offers this dividend. So I think that gap closes. I mean, I wouldn't suggest short tech, long value, but certainly just by kind of reducing your exposure to those tech names, those 7 big names, if the overall market rallies, I think that gap will close.
Yeah, I also think we are certainly seeing a little bit of that broad-based move in terms of flows. Again, gives you some idea of where investors' head might be at. But certainly on RSP, I think it is a concern of advisors and certainly the clients that we talk to that are concerned about that concentration risk in those, at least the Magnificent Seven and some of the indexes, but also those who are looking for ways to potentially place a mean reversion in some of those lower valuations that you're seeing. And RSP is just one little example of how to play that trade.